Hey folks, welcome back to Money and Politics. It is July 21, 2021. And the year now is halfway over, and let's take a look today at a couple of things that just to review, and we're going to got the Money and Politics tweeted up there, and there's the email. I wanted to get that out of the way real quick. So, I don't know that there's good news or bad news. I think we're somewhat in the summer doldrums, and I think that the market is looking for a direction. And when it's looking for a direction, I think it is overreacting and on both sides. It goes down too far, it goes up too far, because it doesn't, it's kind of like I used this analogy before, it's kind of like a speedboat on a lake without a rudder. And it's going fast, but it doesn't know in what direction it wants to go. And all of a sudden, some wave will come along and the speedboat bumps off to the left, and then another wave comes by and the speedboat goes off to the right. And you say, well, why is it going to the right? Just because. And that's kind of where the market is now. I mean, more sophisticated people will say, well, because it's the 30-year bond or the 10-year bond or the interest rates or whatever. Sometimes those reasons are valid. A lot of times when you hear people talking on some of the financial networks, they're saying something because they got to say something. My gut feel is, and this often happens in the summertime, that, we're just kind of in between. We're just floating along right now like without direction. And I remember a couple of years ago, just to illustrate the point, and this was also in July. I'm going to guess it was probably around 2014, 2015 maybe. But it illustrated the point. Every day for 5 days, the 5 trading days, the Dow would move by 3 digits. In other words, it would go up 100 points or 200 points. So each day, over 100 points. And so on Monday, I don't remember if it went up or down, but let's just say it went up. And then on Tuesday, it went down by 3 digits. And then Wednesday, it went up. And every day, it alternated for this 1 week, going up or down. And what does that tell you? I think it's a perfect illustration that in the short run, the market doesn't have a direction. And sometimes it will for obvious reasons. Sometimes, like when 9/11 happened, we're going down. Sometimes when 2008 in the fall, September 2008, we had the real estate crash, it was going down. And it predominantly went down. There's always some little hiccup along the way where it went up. But the trend was down, and it was down until March the 9th of 2009. So it went down. When you have a real strong market direction like that, we know where it's going. When you don't, and that's where we are now. Other times, by the way, after Trump was elected, it shot up, and you could do no wrong. Where we are now, I think, is in neutral territory. And that's the overall market I'm talking about. So we look at what Humble did today, and the kind of the good news is that we see that Humble is holding its own. Obviously, I'm not going to get real excited and say hooray, hip hip hooray for going up 2.5 cents. It beats, getting a stick in the eye. If it went up 50 cents, that would be something to pound the table on and pop a cork. But I like that it's holding its own right now. And that's the thing that I wanted to bring to your attention. If we get a little bit of a close-up view here, we can see that we had volume of 2.7 million shares, and that is the last 10 days was about 9.5 million. So the volume was light today. And you can see that that's the one-day trend, and here's where we are over the last month. So it'd be nice for us to reverse course. I think hopefully we're finding a bottom. You never know till you see it, but that's where we are on Humble. Now, one thing I think would be kind of fun to do is something I like to do every so often, and to remind you how you can look at things. So let's bring up a review of the overall market. Now, this is the S&P 500, which I and others would say is the benchmark. So if you're buying something, or if you're having something recommended to you, you might want to say, is it doing better than the S&P 500? Typically, I'm going to go by a 5-year period. And here's what the S&P did over 5 years. You see the volatility in it. You see that when we got to COVID and we had that sharp drop off, and then at about a year ago, and that was the bottom was right around St. Patrick's Day of 2020, and then we've been predominantly up in the market since then. So that's the S&P 500. Let me throw in, and it's going to be a little repetitive, but on the other hand, I haven't done it in a while, so the numbers are going to be different. And for those of you who are watching who haven't seen this before, there are leveraged versions of the S&P 500. So let's put in UPRO, which is a 3 times leverage version. So if you're in a market where the strong direction is up, boom, that's the difference between the leverage version of the S&P 500 and the S&P 500. Remember, when you buy either one of these, you are diversified. You're always going to get some people to argue. You know, I get people, oh my God, you shouldn't tell people to go into that. Well, which one would you rather have been in over the last 5 years? The red line or the black line? Okay? So you can see when we got COVID, the one thing, because this is leveraged, it's going to go up a lot faster than an index, and you see that in black, that is not leveraged. It's also going to go down much faster, and you see that in the COVID drop-off right here, where it just fell precipitously and hit, boom, a bottom. When that happens, and you're going to feel like crap, okay, you would. You got to remember a picture like this and say, is the market overall going to remain down? Is the bad thing that we're in going to remain forever? Did 9/11 turn down, remain forever? Did the COVID turn down, remain forever, etc.? And of course they don't. And then when we get up to, there's September, I was actually kind of surprised we didn't have a sharper turnoff when Trump was declared to have lost the election. And I think we didn't because simultaneously at that time, we had the news of the COVID vaccine coming out. And so there were, that bounced off, the market loved Trump's pro-business policies. Now, anyway, let's move on. So let's take a look. Now, let's throw in the NASDAQ. And you see here's the 3 primary indexes. And so Yahoo Finance has them there for you, the Dow, the NASDAQ, the S&P. If we just click the NASDAQ, I don't like that light green, and let's make that boom, and there you go. So you see that green line is not a leveraged index. That is just the green line. I'm going to have to move myself here. But that is, let's see if I can, anyway, I'll take myself out. The green line is not a leverage index. That is the NASDAQ. The NASDAQ will typically, though not always, but typically, and again, this is a 5-year chart, and you can see the green line is above the black line being the S&P 500. The NASDAQ will typically outperform the S&P 500. There is a leveraged version of the NASDAQ, and that is, put the symbol in, T as in Thomas. Q, 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 and you see it there. I often refer to it as TQQ because I get tired of making it 3. It's 3 Qs. Okay, TQQ. Now, let's do that. And let's pick some bold color. Let's say that's gold, okay? Bang, look at the difference. Now are you going to tell me that we shouldn't be in a leverage index? Should we only be in the S&P 500, which over the last 5 years is up 100%? If you see that in the lower right, just above the Money and Politics logo, which I can take out there. But you see, once you put on these charts more than one line, then you get the growth in a percentage on the far right column. So the black line, the S&P over the last 5 years, up 100%. The green line, which is the NASDAQ, is up 180, we'll call it 187%. Then you have the leveraged version of the S&P, and that is the magenta line. And that's up 378%. You ought to check, folks, your stocks and see how many of them are up over 378%. And you can do that on this chart, Yahoo Finance. And then we have the gold line, the 3 times 3x leveraged index, up 1,271%. Which means that for every dollar you would have invested in there, I'm doing this math from, you correct me if my math is wrong, but I believe for every dollar you put in there, you would have had $127 today, as compared to for every dollar you would have put in the S&P, you would today have $2 because it went up 100%. So do you want to have $2 or do you want to have 127? So that's why we invest in leveraged indexes. And this is why you want to have your money in leveraged indexes, especially as the market is on an upward trend. Now, there are short versions of this. As an example, the short version of the TQQ, 3 Qs, is the S as in Sam, QQQ. So if we were in a market where, like after 9/11, like after the real estate crash, that would be a time that you could put some money in a leveraged short index. Let's now bring in some of our favorites. And we know Humboldt is going to be down. It's been down since February. By the way, let me change this chart for a minute. This is a 5-year chart. And what I want to do, let's see how we've done year to date. Who's the winner? Well, see how it changes. Now, year to date, interestingly, the UPRO, which is 3 times the S&P, is the winner, up 50% since the beginning of the year. Then we get the TQQ, the 3 times the NASDAQ, up, I believe that's 39%, followed by the S&P, and in last place is the NASDAQ. So the NASDAQ has had a tough year. Remember I said normally the NASDAQ, which is that green line coming in last since the beginning of the year, the NASDAQ typically is going to be beating the S&P 500, the black line. So far this year, it is not. And if we say, well, what did it do over the last 1 year? Interestingly, again, the UPRO. This is why even though the S&P or the TQQ is up 1,200% over the last 5 years, you're going to get changes of who wins over different time periods. In the long run, if you told me or asked me which one would I say is going to be the number one, I would say it's probably going to be the tech sector, which would be the TQQQ being leveraged. But as you see, and this is a 1 year, the leveraged version of the S&P, which is 500 different companies, that's the UPRO, that's the red, came in number 1. In 1 year, being up 125% ain't bad, right? The average return of the markets over the last 70 years, I get different numbers told to me, but it's roughly 8%. Sometimes some people say 10%. I think it's in that range, okay, without quibbling for the moment. So if you can make 125% 1 year, booyah. If we go 2 years, there you go. This is why you want to put some money in the S&P 500 leveraged, which is UPRO, and you want to put some money in the TQQ. The current price of the TQQ now, and by the way, that just split 2-for-1 in January, I believe. The current price is $126. The UPRO is $115 a share. So, but this, folks, if you're nervous about putting money into one stock, and I say, when you put money into one stock, we see it with Humble, that represents a one company risk. One company. It could be Amazon, which goes to the moon. It could be maybe you put money into Sears because you inherited it from your grandfather and he bought it back in the 30s. But now look what's happening to Sears, you know, I mean, or Kmart, you know, which is now also Sears. Or if you had inherited Woolworth, I don't even know that they're in business anymore. This is why whenever you're in one company, you could have a one company risk. When you invest in these indexes, you are diversifying yourself. Whether they are leveraged or not, you are getting the benefit of diversification of those indexes. I would say go with the leveraged indexes, but if you get a rough spot, if you get that spot like we did when we hit the downturn of COVID, then you let's see if we got that. You know, you want to make sure that you know that you're going to have them come back faster. So the TQQ is up higher now than it was before COVID fell. It's gone all the way back up and then some. And again, if you have other stocks you want to put in and you say, well, let's say for the last year, because we've been talking on Money and Politics for a year, and over that period of time, it's been a significant year because we've had the change in administrations, and that can have an impact. If we put in, by the way, DIG, D-I-G, which again I've talked about, that's the leverage version of oil and gas. And I don't know that light blue. Let's see if we can make it a darker blue. So you see, of late, the oil has come down. So over 1 year, it's done better than the NASDAQ and the S&P 500, but less well compared with the leverage versions of the indexes. So it's not bad. It's up, you know, in 1 year, 27%. And if you go back just before the sell-off, and back to June, you know, you go back roughly a month ago, it was up much closer to 100%. So it's had this sharp decline of late, but I would say, if you look again over a 2-year period, it's, you know, it's way down because it was way down. And you see it now way on the bottom. And I picked it because I thought, as I said before, that we would be coming out of the COVID-19 shutdown. And so if we go to year to date, you see the opposite. Instead of it being way down for the year, DIG was the big winner of all of these. And now it's still marginally above the UPRO. But again, you go back just to June 24, recent history here, June 15. And again, it was up, you know, over 100%. So folks, you can keep popping in, and this is such a valuable tool. I recommend that if you have your money into mutual funds, which I'm not a fan of, I've said that before. I'm repeating some of this because a lot of people are joining the channel, watching for the first time. If you have your money in mutual funds, take your stock symbol, put it in that left-hand corner up in the left here where, you know, it's a drop-down menu. So you click on that and you put in whatever your stock symbol is. A friend of mine has a mutual fund, the Morgan Stanley Institutional Global, which actually for a mutual fund hasn't done bad, at least last time I checked. And that's MSGL. OPX. I am not recommending it. I don't recommend mutual funds. I don't like them. Let me see if I can use black. And you see that's on the bottom. Let me change that color because we're going to get confused with, maybe a rust color here. So you see, and this is why I don't like mutual funds, over the last, or year to date here, that mutual fund is on the bottom, up only 4.5%, when you could have had 4 times that by just putting money in the S&P. That's the black line. Diversified by 500 different companies, and your money would be in every sector. Again, you go into the TQQ, instead of being up 4.5% in 1 year, you'd be up 39% with the TQQ. If you go to 1 year, see it. Let's see, do we see it over 2 years? Sometimes this, when you click, it drops something. Yeah, so it's just not, for some reason, showing up. What I would say, folks, but we're already running long here, that don't forget these leverage indexes. And don't forget to take and put your money where you're going to get a reasonably safe rate of return, and that's in leverage indexes. So if you pick individual stocks, and you can put some in there, because we could get Humble, which is 97 cents today, right? And we could get Humble, and theoretically, all right, theoretically, we could say that Humble could go to $10. Well, if Humble went to $10 in 2 years, which it certainly could, that would be 10x, 10 times where it is today. You're not typically going to get that in the indexes. So you want to put yourself in a position to get those 10x or 20 or 50x investments. And that's why here and there you also put money into some individual stocks. But I use, for myself, these leverage indexes as kind of my anchor. And I was noticing with a friend of mine who, I can check some of her investment, her investments in the indexes, and basically she has put about $16,000, 400. She let me look at this. She put I'm not going to show you her portfolio, but she put $16,000, let's say $500 into a slew of some of these leverage indexes. And on $16,500 invested, she has a gain of $20,160. So the gain is 123% on that. Okay, so $16,000, 500 invested, made her 20,160. On some of the individual stocks, she has 41,000 invested, and that's made her a gain of $9,200, which is a gain of 22%, but nowhere near the gain of 122%, which she has on her indexes. So her lesser amount of money, which is $16,000, made her a lot more money. The $16,500 earned her a lot more profit than the $41,700 did. So when you're investing in your career and you're learning the ropes and you want to get your money grow as fast as possible, these leverage indexes can put you ahead of the game. And when someone says, well, you ought to put your money in X, Y, and Z, go over to Yahoo Finance, go over to the S&P 500 I put in, and then I click, just like here, let me do this. This is our Humble page, but let's say this is the S&P. You go here, it gives you this chart, but in the upper right, you click on full screen, And then that will give you the performance of that chart. And it tells you what the current price is until you put in something else. So this is, let's make it year to date. This is Humble, but if we say, well, what if we had put our money in the NASDAQ? How would that compare to Humble? You know that Humble's been down, but look at that. I mean, the NASDAQ's not had a good year, and interestingly, as much as we've been down in Humble, Humble is still beating the NASDAQ. Now, I've changed the colors here from the previous chart. And if we say, well, how did Humble compare to the Dow Jones if we had the money there? Well, let's make that gold. Boom, look at there. Humble is still above. So even as bad as all of us would go, oh my God, Humble's been horrible since February, and it has been. You can look at the chart. But it went up vertically, went up parabolic. It went up way ahead of itself. Where it is now, and that's the other thing, where it is now, Humble, I think, is far more of a sustainable kind of a price than where it was when we started the year, and it went shooting up in that parabolic fashion. And yet, even with that parabolic, we see that Humble there in blue is beating the S&P. It's beating the Dow Jones, or it's beating the NASDAQ, and it's beating the Dow Jones. And let's throw in the S&P, and just for fun, we'll make that green. I don't think we have a green in there. There again. Humble, still above. Hopefully that makes you feel better, because I want you to make you feel better. Frankly, that even surprises me, because we're down so far. And again, this is where we're down at 97 cents. But this is where we still have had some growth in here, even though if you bought back at the high points, obviously you're going to be underwater. However, go back to what I said. You want to put yourself in a position periodically to hit a grand slam home run. And you're not going to do that with the indexes, but the indexes are going to give your portfolio some stability. And if you use the leverage versions, then you're going to be able to have your portfolio growing a hell of a lot faster than 8, 10, 12%, a hell of a lot faster. Even when the market goes up 20%, you might be up 60% or more, because you're using those levers. So folks, my goodness, we always go so long here. I'm almost a half an hour long. I hope this helped you. For some of you who have never seen it, for those of you who have, I hope this is a good reminder. As a reminder, there's my email if you haven't seen it before, and if you want to follow me on Twitter, which I don't tweet a lot, but I do on occasion, so you can do it there. And with that in mind, I'll let you go. Have a great night. Leave your comments. Tell me what you think. I'm always interested, okay? And we'll see you, folks. Enjoy your evening. I'm going to head out to the gym, trying to get Papa Humble back into being in shape. All right. Till later.